Welcome to the deep dive. Today we're really digging into the Morgan Stanley 2022 Shareholders Letter. And this isn't just, a quick look back at earnings, it's more like a roadmap. It shows how they wrapped up this huge 12-year change and, maybe more importantly, what they're aiming for next. Really aggressive goals. So if you want the inside track on how a giant bank like this changed its whole game plan, well, this is the deep dive for you.
It really is a fascinating read because you have to remember the context for 2021. The economy was bouncing back strong, lots of capital around, but at the same time still dealing with COVID variants, global uncertainty, that kind of thing. And the letter really lays out how they didn't just navigate that, they actually used it to prove their big strategic pivot was, well, working after more than a decade.
And the results, they really do speak for themselves. You have to start with those headline numbers. Morgan Stanley put up some, frankly, incredible results. Record revenues, what was it, $59.8 billion, and net income of $15 billion. But the number that really tells the story, the one we need to focus on, is that ROTCE, return on average tangible common equity, came in at a huge 19.8%.
Yeah, let's just pause on that ROTCE for a second. For listeners maybe not totally deep in bank metrics, ROTCE is super important. It's profitability against their capital minus the intangibles, hitting almost 20%. That's transformative. After the 2008 crisis, many big banks struggled just to get consistently into double digits. So 19.8%, it signals a really elite level of profit and efficiency.
Okay, so let's unpack that. A number like 19.8%, that doesn't just happen because you had one good year. It's going to be engineered, right? The letter talks constantly about this 12-year pivot being complete. They moved away from just being an investment bank. What exactly did they transform into?
They fundamentally changed the risk profile of the whole firm. That's the key. The shift was moving away from being so reliant on the, let's say, the ups and downs of institutional securities, the ISG, traditional M&A, trading. That can be volatile, towards a much more balanced firm. And the new powerhouses are wealth management, WM, and investment management, IM, because they generate more durable fee-based revenues, recurring income.
Right, and you can see that long game playing out. The letter points out total revenues more than doubled since 2009. That's not just market growth, that's a deliberate rebuild.
Exactly, it is. But getting there meant they essentially had to buy those steady revenue streams, which is why those big acquisitions, E-Trade and Eaton Vance, were so critical. They were the linchpins. E-Trade gave wealth management massive scale, plus the tech. And Eaton Vance basically instantly turned their investment management arm into a major diversified player.
But buying huge companies like that, E-Trade, Eaton Vance, that's got to come with enormous integration challenges, right? Tech, people, culture. The letter paints it as a smooth success, obviously, but strategically that must have been complex. Were they risky bets?
Oh, absolutely risky. Huge bets. But the execution seems to have paid off, and paid off really well. The letter definitely celebrates it. And it emphasizes these weren't just about, bolting on assets. It was about achieving a totally new scale. By the end of 2021, the client assets combined across WM and IM hit $6.5 trillion. That number, $6.5 trillion, that's the proof the transformation worked.
Okay, so why should you, listening now, care about $6.5 trillion? It means Morgan Stanley is less dependent on those big market swings, the investment banking booms and busts. They're focused more on the steady, almost annuity-like fees from managing all that money. It makes their earnings more predictable, probably boosts their valuation too.
And you see that stability reflected in the other 2021 numbers, beyond ROTCE. Look at the capital return. They doubled the dividend. Doubled it, and announced a massive $12 billion share buyback program just for 2021. That kind of payout shows huge confidence in the future earnings power of this new diversified model.
And they weren't just making money, they were efficient about it, which is crucial for a firm this size. The firm-wide expense efficiency ratio, basically costs versus revenue, was 67%. That's really good, especially since their own target was just to stay under 70%.
Right, and underpinning all that was the balance sheet. Rock solid. They talk about fortress capital strength. The CET1 ratio, Common Equity Tier 1, was 16.0%. Just translate that a bit. CET1 is that core safety capital cushion. Holding 16% against their risky assets is way above what regulators require. It gives them massive flexibility, for growth or to handle any market bumps down the road.
Okay, let's break down the three main parts of the business now, starting with ISG institutional securities. Even with the big strategic shift, the investment bank clearly wasn't just coasting.
Not at all. ISG proved it's still a major force. Pulled in record revenues of $29.8 billion. And that integrated part is key. They use relationships across the whole firm to feed that business. And within ISG, performance was strong everywhere. Investment banking, equities both hit record revenues. Fixed income had its second best year in like a decade, and they're still a leader. Number two globally in equity revenue share, what was it, 22.5%? So yeah, the overall engine is more balanced now, but the original core still delivering huge power.
Okay, now here's where, for me, it gets really interesting. Wealth management, WM. The scale they've built is just, it's mind-boggling. They added nearly $1 trillion in client assets in 1 year to reach $4.9 trillion by the end of 2021.
It's monumental growth,
Yeah.
driven by $438 billion in net new assets, mostly coming through their advisors. But the really clever part, what the letter highlights, is this idea of being a category of one.
Mm-hmm.
They achieve that by knitting together three channels: the traditional advisor model, the E-Trade self-directed platform, and then, crucially, the workplace channel.
Ah, the workplace channel. That's the pipeline for future growth, isn't it?
Exactly. That's where they manage retirement plans and stock options for employees at big companies. It holds over $500 billion in assets that haven't even vested yet. So they're basically capturing the next generation of clients way before that money is even fully theirs. And the goal, stated right in the letter, is to keep 30% of those assets when they do vest and become liquid. That's pure built-in future growth, planting seeds for years to come.
And they're obviously betting big on the segment's profit potential, too. The WM pre-tax margin was already good, almost 27% in 2021. But they set this really aggressive new target. Push that margin to 30% or even higher, that's going to take serious cost control, plus scale benefits and maybe higher fees.
Then shifting over to investment management, IM, you really see the Eaton Vance deal paying off immediately. Assets under management, AUM, shot up to a record $1.6 trillion. And they had really strong net inflows too, $115 billion coming in.
And what about the types of assets? It wasn't just about buying bulk AUM, was it? They bought specific skills.
Correct. Eaton Vance didn't just add scale. It made IM a much more diverse manager, especially strong in two key growth areas. First is customization. That's through their parametric brand, think specialized tax management, unique portfolios. And second, sustainability through the Calvert brand, which is a big name in responsible investing, ESG, and so on. Plus, they're pushing into alternatives.
Uh-huh.
Yeah, private equity, hedge funds. They mentioned having $210 billion in investable capital there now. Higher margin stuff.
So, connecting all these financial and strategic moves, the letter makes a big point about culture, values, vision. It feels like more than just boilerplate PR. They present it as essential for actually managing $6.5 trillion and attracting the right people.
Absolutely. It's framed as mission critical. They talked about setting actual 3-year targets for diversity representation, making themselves accountable, and they backed it up, promoting their biggest ever class of managing directors, highlighting that a third were women, and it was their most ethnically diverse group ever promoted. The message is clear. Complex global business needs diverse perspectives.
And they're pushing that focus outside the firm too, right? Mentioning things like the Next Level Fund and expanding the Multicultural Innovation Lab, basically using their own capital and know-how to back underrepresented entrepreneurs.
Yeah, and maybe the biggest, most strategic commitment outside the pure financials is on sustainability. They outlined this huge target, $1 trillion in financing for sustainable solutions by 2030.
$1 trillion. Wow. How does that break down?
Well, a big chunk is tripling their commitment to low-carbon financing, up to $750 billion. And the real headline grabber was their claim they were the first major U.S. bank to commit to net zero financed emissions by 2050. That's not just about being green, it's strategic positioning. They want to be the go-to bank and advisor for the massive transition to a lower carbon economy that's coming. They're betting big on capturing that flow. And, just to bring it back to the immediate context of early 2022 when this was written, the letter does ground itself. It acknowledges the war in Ukraine, calls it a humanitarian tragedy, and warns it's a potential serious risk for the global economy, even if Morgan Stanley's direct exposure is limited. So they're launching into this next phase aware of the macro headwinds.
Okay, so let's pull it all together. What does it mean for you, the listener? The main message seems to be, Phase 1, the big 12-year transformation, is done, complete. They're not trying to fix the model anymore. They're confident in it. Now it's all about execution, hitting the numbers. And to underscore that confidence, they laid out some seriously ambitious new long-term goals, pushing that ROTCE consistently to 20% or more, keeping the wealth management profit margin at 30% plus. And the big one, the number that really shows where they're headed, a longer-term target of $10 trillion in combined client assets across WM and IM.
$10 trillion. And they justify that huge number by pointing to their scale, how the different parts of the business feed each other. And they also explicitly mentioned expecting a tailwind. They think rising interest rates over the next few years will significantly boost fee income in both wealth and investment management, helping them get there faster.
Right, which brings us nicely to our final thought for you to chew on. Given that this whole next growth chapter relies so heavily on WM and IM succeeding, and since those businesses, according to the firm itself, are counting on rising rates to boost profits and attract assets, how might things change if global interest rates don't follow that expected path? What if rate hikes are delayed or smaller than expected? Could that challenge, or maybe even accelerate in some weird way, their path to that huge $10 trillion asset goal? That interplay between the macro environment and their core strategy. That seems like the key thing to watch going forward.